The President of Turkey is calling for patience, asking fellow Turks to trust his plan to address an economic crisis.
Turkey engorged itself with cheap foreign loans, many held in US dollars, when interest rates were low in the US and elsewhere.
Turkey, a nation that bridges Europe and Asia, rich in history, culture, and natural beauty. For years, it was celebrated as one of the fastest-growing economies in the world, even being called a rising star.
The lira rapidly depreciated to new lows in 2021, and in January, the inflation reached the highest recorded since the year 2002.
But today, the story looks very different. Inflation is out of control. The currency has lost most of its value, and ordinary people are struggling to buy even basic necessities.
Under pressure from the president, Turkey's central bank has slashed rates in recent months, triggering a currency crisis.
So, how did Turkey go from being a model of rapid growth to an economy many say is collapsing? Let's break it down. The heart of the problem is the Turkish lira.
Global financial markets continue to be rattled by the economic crisis in Turkey. The country's currency has plunged to a record low against the US dollar, prompting the Turkish central bank to take measures.
Over the past decade, the lira has lost nearly 90% of its value against the US dollar. To give you an idea, if you had 100 lira in 2013, it was worth $55. Today, it's worth less than $4. That collapse makes everything imported, food, cars, fuel, and even basic electronics, painfully expensive. So why did this happen?
Turkey's central bank has nearly doubled its main interest rate in a major reversal from the unconventional economic policies originally promoted by President Recep Tayyip Erdoğan.
A big reason is the government's usual approach to interest rates. Normally, when inflation rises, central banks raise rates to cool it down. But President Erdoğan insisted on cutting them instead, believing low rates would boost growth. Investors saw this as reckless. Confidence in the lira evaporated. People started moving their savings into dollars or gold, and the currency fell off a cliff. Once people stop trusting their own money, it's almost impossible to stop the free fall.
Turkish inflation has surged since last autumn after the central bank launched an easing cycle and the lira weakened.
And that brings us to inflation, the silent killer of every economy. Officially, inflation in Turkey has hovered around 50% in recent years.
Turkey is an emerging market. It's seen 2 decades of broad economic growth and an expanding middle class, but now the lira is in freefall as the country reckons with President Recep Tayyip Erdoğan's unorthodox economic approach.
Independent economists say it's often much higher. Imagine your rent doubling in a couple of years, or your grocery bill shooting up every single month. That's daily life in Turkey right now.
Turkey's latest inflation figures hit its citizens where it hurts, in the kitchen. The Turkish Statistical Institute put the annual inflation rate at 20.35% in January.
Food is the clearest example. Simple staples, bread, eggs, vegetables, that once cost pocket change are now luxuries for many families.
Turkey is in economic turmoil. People are queuing for bread, cutting back on meat, and are even fleeing to other countries.
Rent prices in Istanbul have become so high that even working professionals are struggling to keep a roof over their heads.
Energy prices leapt to multi-year highs as the West sanctioned Moscow. Turkey imports almost all of its energy needs.
And because Turkey imports so much of its energy, global fuel price spikes hit households directly. Power bills are eating up bigger and bigger chunks of paychecks. Inflation doesn't just squeeze people, it breaks trust. If you know your salary will lose value next month, why save? Why invest? That uncertainty stalls the entire economy.
Loan growth in Turkey has suddenly started to pick up, and in a big way. I think consumer loans are now up 45% year on year. Business loans are up about a third of that.
Another issue is debt. For years, Turkey relied heavily on borrowing from abroad to fuel its rapid growth. Banks and companies took out loans in dollars and euros. That worked fine when the lira was relatively strong, but once the lira collapsed, paying back those loans became far more expensive. This heavy foreign debt means Turkey is highly vulnerable to global financial shifts. If investors lose confidence, they pull out money, and the lira sinks even further. It's a vicious cycle.
President Tayyip Erdoğan has put pressure on the central bank to move towards an aggressive easing cycle. His aim is to boost exports, investment and jobs, even as inflation soars and the currency's depreciation speeds up.
Economics and politics are deeply connected in Turkey. President Erdoğan's government has centralized control over institutions, including the central bank.
The governor of Turkey's central bank, Murat Çetinkaya, has been fired and replaced by his deputy. The move was ordered by Turkish President Recep Tayyip Erdoğan, but no official reason has yet been given for Çetinkaya's dismissal.
He has fired multiple central bank governors who disagreed with his policies, creating uncertainty and scaring off investors. At the same time, political tensions, both inside the country and with international partners, have made foreign investors cautious. Without stable, predictable policies, money flows out instead of in. So what does all this mean for ordinary Turkish citizens? It means wages can't keep up with prices.
The Turkish middle class may also be among those affected by the country's challenging economic conditions. Many are struggling to make ends meet amid high inflation, stagnant wages, and declining purchasing power.
Many middle-class families are slipping into poverty. Young people are leaving the country in search of better opportunities abroad. And small businesses, once the backbone of the economy, are shutting down because they can't handle soaring costs.
All is quiet in Antalya's harbor. Usually, it's a lot busier this time of year. The captains of the tourist boats here say visitor numbers have plummeted up to 70%.
Tourism brings in some money, but it's not enough to offset the deep structural problems. Can Turkey fix this? In theory, yes. The country needs independent monetary policy, higher interest rates to control inflation, and reforms to rebuild trust with investors. Turkey also has advantages: a strategic location, a large population, and strong industries like textiles and manufacturing. But without serious political will and long-term reforms, these strengths may not be enough. Turkey was once hailed as an economic miracle. Today it's facing one of its toughest challenges in decades. A collapsing currency, runaway inflation, and political decisions have pushed millions into financial hardship. The big question is, will Turkey's leaders make the hard choices to stabilize the economy, or will things continue to spiral? What do you think? Can Turkey turn things around, or is the damage already too deep? Let me know in the comments. And if you enjoyed this breakdown, don't forget to like, share, and subscribe for more insights into the world economy.